And on today's show, why some life insurance income strategies are crystal clear alternatives. Part 1 to this week's series on life insurance income strategies with life insurance income strategist Don Prehn, CLU ChFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Don.
Hey, Steve. Good to see you.
Don, I love this. These first two shows, we're going to talk about crystal clear alternatives. Sometimes we kind of say, hey, is this a good deal or a bad deal? But this one I want to talk to you about. I have a female, 35 years old. She has a daughter, Caroline, and she's a self-employed artist. So she's got to really kind of do all this on her own retirement, indemnification for her daughter. We're looking at $1 million worth of death benefit and she needs some retirement flow at age 65. I kind of wanted to walk through this a little bit before we get to this, and I want you to say what we're doing here.
Sure. Here we have a 5-pay, $22,753, 5-pay premium, and here you'll see the cash value growing over the first 30 years up until she's 35, so until she's 65 years old. We have $1 million level death benefit, and then starting at her retirement, we start pulling out some retirement income here. You'll see $52,000 and change, and then it's growing throughout her life expectancy.
And keep in mind, we have it at a 35% tax bracket. We're showing an illustrated IUL rate of 7.5, and the initial payments are a 5-pay using option A, which in my vernacular is level death benefit, to get this number. So that's a really good income stream for her. I want to go back to the original blog now. This is a kind of a pictorial version of what we just showed on the numbers.
That's right. This is a way to simplify what's happening with the policy. And what's great about this is you can use this on almost every case that you do because it's such a great representation of what's happening in the policy. And here you can see this little tiny bar at the bottom is the cumulative premium. That's your $22,000 a year 5-pay cumulative. See, it grows there over time. Mm-hmm. And then what's happening is the red is the death benefit, the blue is your cash value, and then the green, starting at her retirement, are the loans that are coming out of the policy to supplement her retirement income.
This is really good because remember, many clients are very visual, and I like the beauty of this pictorial graph. Now, I love this summation graph that you have here. This is really great. Give me the pre and post.
From a pre-retirement standpoint, you'll see here's the cumulative premium, $113,000. Your cash value grows to $615,000, and you still have your $1 million of level death benefit. Then in post-retirement, you're going to get out about $1.4 million of cumulative distributions from the policy, and out at the end of the policy, you still have the $400,000 of cash value and $540,000 of death benefit.
Now, if we wanted to compare this, let's just take one example. Let's compare it to one idea, one investment. Show us about how that would work.
Sure. In many cases, when you design policies like this, the client's going to want to see what would happen if they put that money in an alternative investment and compare the two. And so that's what we're doing here. Here you have a taxable investment, also at a 7.5% assumed yield. And here you're seeing, this is the year-end account value growing to $432,000 by her age 65, compared to the policy growing to $615,000 because of the tax-deferred benefit of the policy.
So we're paying taxes along the way here.
Yeah, this is showing the tax effect on this alternative investment that has taxable interest. And it's showing the power of the tax-deferred growth inside the policy. And then what's interesting, Steve, is if you go out starting in retirement, when we start taking that $52,000 a year out, look what happens to the other taxable investment. It makes it to her age 73, 74, and then it's depleted. It's completely run out of gas.
And that's about 10 years shy of her life expectancy.
That's right. And the last thing I want to show you is this is a report which shows, it's called our matching report, and it shows what interest rate the taxable fund would have had to earn to be able to pay out the same income and have the same values, and it's 11.4%. So not 7.5%, but 11.4%.
And I just a little side note, not only is you have to gross up to get equivalent numbers, but remember, that does not include the fund's expenses, that doesn't include the statement of information fee, and it doesn't include an RIA fee in that. So just remember, a lot of times I think we're being quite benevolent here. But I like this last one, Don. This is my favorite part of this segment. Now I get multiple ideas, taxable account, tax-deferred account, equity account. You're showing multiple comparisons now for the IUL against other accounts.
Yeah, clearly some clients, when you show the alternative to a taxable investment, that's going to be enough. Other clients who may have more sophisticated portfolios are going to have other investment options. And in this case, we decided to show any taxable investment. There's your $432,000. That's the same one we just did. Then here's a tax-deferred account, an annuity and so on. And here's an equity account, a mutual fund. As you can see, in the first 30 years, you'll see that the values in the equity account are $650,000, tax-deferred account $602,000. They're pretty comparable to what's happening with the policy. But then look, let's see what happens starting in the second 20 years. When we start taking out loans, tax-free loans, we have to gross up the distributions from these other investment alternatives. And as you can see, they do better than the taxable investment, but they don't do that much better. They still run out of gas in her mid to late 70s.
This is an excellent tutorial and a great display to show your client and use multiple investment strategies to give a kind of comparison and kind of an equal footing. We come back from the break, we're going to show you another crystal clear alternative that I think you'll appreciate. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to our second segment. We're with Don Prehn and life insurance income strategist that you are. We're looking at the same person. This time we did a little bit of different idea. We used increasing death benefit over the 30-year period, and interest rate still stayed the same on that. Here is some of the numbers. We're still paying the $22,753, which we originally said, but now we're doing a little bit different idea here because we're going to show her this, and we're going to wind up having to look at a few different ideas because we're going to have to look at buy term invest the difference. That's going to come to the table. We're going to have to look at her qualified plan, which in her case is a KEO. We're going to have to look at a few comparisons and walk me through why this is so superior to either buy term invest the difference or using her KEO to play in this area.
Sure. In the last segment, we talked about Laura's need to develop her own personal retirement plan, and we showed sort of how that plan would work against other investments. She then took that to her CPA, and the CPA said, you know, if you need life insurance, why don't you just buy a 30-year level term and a mutual fund? And so she came back and said, you know, that was kind of the recommendation. You know, how can you guys kind of help me understand whether that's a good advice or bad advice? And so just to kind of go back, to review the policy again, and then we're going to compare buying that 30-year level term and putting the money in some other types of investments. So again, just to review, here's the base policy. We have a 5-pay with $22,753. Now in this case, instead of a level death benefit, we did an increasing death benefit, and we'll show you why we did that here in a minute. So the first question was, gee, does it make sense just to buy a 30-year level term and then to put the money in a mutual fund? So this shows the comparison of, again, here's your 5-pay premium, here's your $700 a year, 30-year level term, and then here is how your mutual fund would grow over time. And as you can see, out at retirement age 65, we have $431,000 in the mutual fund, $594,000 in the cash value life insurance policy. And then here, as we start taking distributions from the life insurance policy, from our tax-free loans, you can see that this mutual fund dies at about age 73. So as you can see, buying the level term and a mutual fund, in this case, didn't make a lot of sense. And the reason we used increasing death benefit, if I can go back here, is if she buys term insurance, she would have the level million of term insurance plus the amount of money in the mutual fund. So she has an increasing amount of death benefit, and that's why when we did the increasing death benefit here, it created essentially the same death benefit with either plan.
Now it's interesting because we show buy term invest the difference. This is one we show a lot, especially if the client's already talking about 20, 25, 30-year term. Right? I mean, that's a long time. Usually we get past somewhere around the 15th, 16th year, we should be looking at this. So anytime you're looking at a sale like a 20, 25, 30-year term, or even low-ball GUL, we really need to be looking at this because this is really huge. Now, what about this now? She still had some headroom in her KEO. They were thinking about doing that.
Yeah, the next question was, if there was room to contribute to deductible plan, in this case she had a KEO plan, the question was, would it make sense to buy term insurance, the 30-year level term, and invest the difference in a deductible KEO plan? And so what we did was we wanted to see what was the equivalent amount of money that she could contribute to a KEO for it to equal what we were suggesting she put in the life policy. And she could put $33,928 into her KEO because she'd get an $11,000 tax deduction, which would be the $22,000 and then the cost of the term. So that made it apples for apples with a $33,000 contribution to her KEO that was deductible going in but taxable coming out. And here's the result of that analysis. Again, $22,000 going in the life policy, $33,000 going in the KEO. Here's the value of the KEO if she were to surrender it and pay tax on whatever was there, because it's all taxable coming out. And it grows to $582,000. The life policy grows to $590,000. Starting in the next 20 years, again, with the tax-free loans. Remember, from the KEO plan, it's all going to be taxable, so we have to gross up the distributions. And it does better, but it still runs out of gas at about age 80. So again, we're showing that even if she could put money into a deductible plan like a KEO, the cash value policy with its tax-free loans still outperforms.
Now, Don, I just want to make sure I heard you right here.
Yeah.
We're pretty much even on the cash value here, accumulation. So really the issue is not who accumulates the most, because it's pretty straight up even. But it's when we get to distributions that the real drama begins, because when I start grossing up my KEO plan to make sure I'm getting the same money out, and remember, just a little side note, any of this money coming out here is going to fall on your Social Security provisional income test to see if your Social Security benefits will get taxed. And of course, depending upon your exemptions and so forth, that'll be exposed and that'll be used in your provisional income test for Social Security, but not for these loans. So that's what I like about this, because we incorporated the tax savings on the KEO, to be fair. We also showed the term insurance that she was paying and tried to composite all this to get a net idea. She paid $700 for her term insurance. We were giving her the deduction on the KEO. We were even money, pretty close on the accumulation, but when we hit distributions, it really matters.
Yeah, and the reason we were equal on the accumulation is because we're showing how much money she'd really get if she took all the money out of the KEO and paid tax on it. Because having a big balance in a KEO pre-tax doesn't mean anything. You need to look at what's the value of that money in that KEO if you take it out and pay tax on it, and that's what we showed.
I love this. This is crystal clear. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.